So you want to buy a self-storage facility. From the road, it looks like the easiest business in real estate. A fence, a gate, and rows of metal doors. There are no kitchens, no showers, and no tenants calling because a toilet is leaking through the ceiling. Customers bring their own stuff, lock the door, and pay you every month. Some barely come back. It sounds almost too easy, and that is exactly why people overpay. A storage facility can look full, collect hundreds of thousands of dollars, and still leave the owner with almost nothing. The building is simple, but the deal is not. So let us buy one. Imagine a 500 unit facility listed for $7.5 million. It collects about $720,000 a year in rent and fees, and after normal property costs, it keeps about $450,000. That sounds great until the bank enters the story. For this example, you put down 35% and borrow the rest at 7%. The loan costs about $413,000 each year. Your facility made $450,000, but the bank took $413,000. You invested more than $2.5 million and ended the year with about $36,000 before income taxes, major repairs, or surprise costs. That is a cash return of roughly 1.5%. Congratulations, you bought 500 storage units and built a slightly stressful savings account. So why do investors love this business? Because the same property can be a bad deal today and a very good deal later. To understand how, you need to follow three numbers: rent, occupancy, and debt. Miss any one of them and those metal doors can hide a very expensive mistake. Start with rent. A storage facility does not sell one product. A 5 by 5 unit, a 10 by 10 unit, and a large drive-up unit may sit on the same property, but they serve different people and earn money in different ways. A small unit may earn more rent for each square foot, while a large unit brings in more dollars each month. Climate control can support higher rent, but it also adds power bills, repairs, and equipment that can fail during the hottest week of the year. The best mix depends on the neighborhood. Apartment renters may want small units, families between homes may need larger ones, and contractors often want drive-up space. A facility can have the right number of doors and the wrong kinds of doors. Then comes occupancy. A seller may tell you the property is 95% full. That sounds close to perfect, but full does not always mean profitable. Some tenants may be paying old rates, some may have a discount, and others may be late or not paying at all. Physical occupancy tells you how many units contain stuff, while economic occupancy tells you how much money is truly coming in. Those are not the same thing. Here is where the business gets strange. A facility can be too full. If every unit is taken and people keep calling, the rent may be too low. The owner is turning away customers who might pay more. Hotels understand this, airlines understand it, and storage companies do too. The goal is not to fill every unit at any price, but to find the best balance between rent and empty space. If you enjoy seeing the real math behind businesses that look easy, subscribe. That is what this channel breaks down. Now we reach the number that causes the most pain: debt. The property may earn a good return before the loan, but you do not live before the loan. You live after it. Storage facilities are often valued with something called a cap rate, and the idea is simple. Take the yearly income left after normal property costs and divide it by the price. Our facility keeps $450,000 before debt. At a price of $7.5 million, that is a 6% cap rate. But a 6% cap rate does not mean you earn 6%. It describes the property before your loan, so expensive debt can send most of the cash straight to the bank. The property can be healthy while your investment is weak. The bank may own none of the units, yet still collect almost all of the cash flow. So why buy the property at all? Because a small rise in income can create a large rise in value. Suppose you raise yearly income by $50,000 by filling empty units, improving the website, cutting waste, adding online rentals, or bringing old rents closer to the current market. At a 6% cap rate, that extra income could add more than $800,000 to the value of the property. You did not build $800,000 of metal, you created $50,000 of income that may repeat each year. This is where skilled operators make their money, but the same math works in reverse. Lose $50,000 of income and the property may lose more than $800,000 in value. A few empty rows can erase years of profit, and those rows can appear quickly when a new facility opens nearby. Storage is a local business. Most people want a unit near home, work, or the house they are leaving, and they usually will not drive across the state to save $12 a month. That gives a good location real power, but it also makes a new competitor down the road dangerous. A new facility may offer bright halls, online booking, climate control, and a very low move-in price. New customers compare prices, shop around, and notice a $10 difference. Existing customers act differently. To leave, they must rent a truck, drive to the unit, and spend a Saturday moving things they have avoided touching for 3 years. That effort creates friction, and friction can create pricing power. An owner may offer a low rate to bring a customer in, then raise the rent later. The customer must decide whether paying more is easier than moving everything, and often it is. That is the hidden engine of self-storage. People do not only rent space, they rent time, paying to delay a move, a sale, a clean out, or a hard choice. A customer may plan to stay for 3 months, but the business becomes much better when 3 months turns into 3 years. The demand is real. A 2025 industry study found that about 1 in 8 U.S. households rented self-storage in 2024. Still, strong demand does not make every property safe. You must pay property taxes, insurance, payroll, power, security, repairs, snow removal, card fees, and advertising. Then there is the gate, which will break 5 minutes after the manager leaves. The seller's records may also hide future costs. Maybe the roof is old, the drainage is poor, taxes will rise after the sale, or the seller worked at the property and paid themselves almost nothing. Repairs may have been delayed to make the profit look better. You are not buying the seller's past. You are buying your future, so every cost must be rebuilt from the ground up. Then there is the option to build instead of buy. Building sounds cheaper because you avoid paying a seller for income that already exists, but a new facility opens with hundreds of empty units. The loan starts now, while the rent arrives one customer at a time. That slow fill-up is called lease-up, and it can take years. Public Storage says a new or expanded facility may need at least 3 to 4 years for its revenue to fully settle. 3 to 4 years is a long time to feed an empty building. Large companies can spread that risk across thousands of locations, but a first-time owner with one property cannot. Large operators also have scale. Public Storage reported a same-store operating margin above 78% for 2025. That is an amazing number, but a small owner should not assume the same result. A national company has large ad budgets, pricing software, call centers, customer data, and thousands of locations sharing the same systems. A small owner has one property, one local market, and one gate that still hates them. So should you buy a self-storage facility? Maybe, but only if the deal still works after you remove the fantasy. You need to know the rent that is truly being collected, not the rent posted online. You also need to know which unit sizes stay full, which ones sit empty, and what new storage is being built nearby. You need honest estimates for taxes, insurance, repairs, payroll, and debt after you take over. Most of all, you need enough room in the deal for something to go wrong, because something will. A good storage facility can be a strong business. The buildings are simpler than apartments. Monthly leases give the owner room to change prices, and customers often stay longer than planned. Better management can create real value, but none of that can save a property bought at the wrong price with too much debt. So, you want to buy a self-storage facility? Do not buy the rows of metal doors. Buy the cash flow left after the bank, the bills, and the bad months. The doors are the part everyone can see. The assumptions are the hidden bill. And if you want to see how the same math works for a parking garage, watch that video next.